If you're watching this video in 2026 with $0 in your investment account, you're probably seeing a very different financial landscape than what people faced 5 or 10 years ago. And I'm not going to sugarcoat it. Starting from nothing has never been more challenging, but it's also never been more accessible if you know what you're doing. So let's talk about the actual reality of building wealth from zero in 2026, not the fantasy version you see on social media. What's up, everyone? In today's video, we're going to walk through the complete roadmap for starting your investing journey with literally $0. No fluff, no get-rich-quick schemes, just the raw truth about what it actually takes in today's economic environment. And if you're serious about changing your financial future, make sure you watch this entire video, because the strategy I'm sharing at the end could cut years off your wealth-building timeline. Let's dive in. First, let's address the elephant in the room. The economic situation in 2026 is tough. We've got inflation that's been persistent for years now. Interest rates are still elevated compared to the 2010s. Housing prices in most major cities are at all-time highs. The cost of groceries, insurance, utilities, everything has gone up significantly. So when I say you're starting from zero, I understand that for many of you, zero feels like you're already behind. You're not crazy for feeling that way. The numbers back it up. But here's what's also true. We have access to investing tools and platforms that didn't exist even 5 years ago. Fractional shares are now standard across every major brokerage. You can literally buy 0.001 shares of any company. Commission-free trading is the norm, not the exception. You can open investment accounts with zero minimums. The barriers to entry have never been lower from a technological standpoint, even if the economic barriers feel higher than ever. So let's get practical. If you have $0 today, your first step isn't actually investing. I know that's not what you want to hear, but stick with me. Your first step is creating a gap between your income and your expenses. This is basic math, but most people skip it. You cannot invest what you don't have. You need to generate surplus cash flow, even if it's just $20 or $30 a month to start. Now, I'm not going to tell you to cut out your morning coffee or stop buying avocado toast. That advice is condescending, and frankly, it doesn't move the needle. What does move the needle? Increasing your income. If you're working a W-2 job, can you ask for a raise? Can you switch to a higher-paying company? Can you pick up overtime? Can you start a side hustle that brings in an extra $200 to $500 a month? I know a guy who started detailing cars on weekends and was making $600 extra per month within 60 days. That's $7,200 a year that can go straight into investments. On the expense side, focus on the big three: housing, transportation, and food. These are where the real money is. Can you get a roommate and cut your rent by $400 a month? Can you sell your car payment and buy a reliable used vehicle? Can you meal prep instead of eating out? One person I know dropped their food expenses from $800 a month to $300 just by cooking at home and shopping smarter. That's $6,000 a year freed up. Let's say you've created that gap. You've got your first $50 or $100 ready to invest. Now what? This is where most people make their first critical mistake. They either get paralyzed by choice and do nothing, or they chase whatever's trending on social media. Neither works. Here's what you actually do. Open a brokerage account. In 2026, the top options are still Fidelity, Charles Schwab, and Vanguard for long-term investors. If you want something more user-friendly with a better mobile app, Robinhood and Webull are fine too, despite their reputations. They've all matured significantly. The key is that whichever platform you choose, make sure it offers fractional shares and has zero commission on stock trades. This is standard now, but always verify. Once your account is open, here's your strategy. You're going to invest in low-cost index funds. I know this sounds boring. I know you want to hear about the next big stock or crypto play. But if you're starting from zero, your goal isn't to get rich quick. Your goal is to not stay at zero. Index funds give you instant diversification, low fees, and historically solid returns. The S&P 500 has averaged about 10% annually over the long term, though past performance doesn't guarantee future results. Specifically, look at funds like VOO, which tracks the S&P 500, or V, which gives you exposure to the entire U.S. stock market. The expense ratios on these funds are incredibly low, usually around 0.03%. That means for every $1,000 you invest, you're paying 30 cents a year in fees. Compare that to actively managed funds charging 1 to 2%, and over decades, you're saving tens of thousands of dollars. Now, you might be thinking, what about individual stocks? What about trying to pick winners? Here's the reality. 90% of professional fund managers don't beat the S&P 500 over a 10-year period. These are people with teams of analysts, Bloomberg terminals, and inside access. What makes you think you're going to consistently beat the market picking stocks from your phone? You might get lucky once or twice, but luck isn't a strategy. When you're starting from zero, you can't afford to gamble. Let me tell you about my own experience. When I first started investing, I had about $300. I thought I was smart. I picked 5 individual tech stocks that everyone was talking about. Within 6 months, 3 of them were down over 30%. 1 went bankrupt, only 1 was up, and not enough to offset the losses. Meanwhile, if I had just put that $300 into an S&P 500 index fund, I would have been up about 8%. I learned an expensive lesson that I'm trying to save you from. Here's your actual investing plan when starting from zero. Month 1, you invest whatever you can, even if it's $25. Put it into an index fund. Month 2, same thing. Add another $25, $50, or whatever you can manage. Month 3, keep going. This is called dollar cost averaging, and it's your best friend when you're starting out. You're buying shares regardless of whether the market is up or down. When prices are high, you buy fewer shares. When prices are low, you buy more shares. Over time, this averages out your cost basis and removes the emotion from trying to time the market. The biggest mistake new investors make in 2026 is watching their account too closely. You put in $50, the market drops 5% the next week, and you panic. You sell, lock in your loss, and swear off investing. Don't do this. If you're investing money you won't need for 5, 10, or 20 years, short-term volatility doesn't matter. In fact, it's an opportunity. When the market drops, you're buying shares on sale. Now let's talk about something crucial that nobody emphasizes enough: the order of operations for your money. If you're starting from zero, before you invest anything, you need a small emergency fund. I'm talking $500 to $1,000 in a high-yield savings account. In 2026, these accounts are paying around 4 to 5% interest, which is way better than the 0.01% you get at traditional banks. Marcus by Goldman Sachs, Ally Bank, and several others offer these. This money is for emergencies only: car repair, medical bill, unexpected expense. This prevents you from having to sell your investments at a loss when life happens. Once you have that emergency buffer, then you start investing. And here's the priority. If your employer offers a 401k match, that's your first stop. If your company matches 50% up to 6% of your salary, that's free money. You contribute 6%, they add 3%. That's an instant 50% return. There is no investment on earth that guarantees that. Max out the match first, then move to other investments. After the match, open a Roth IRA if you're eligible. In 2026, you can contribute up to $7,000 per year if you're under 50. The beauty of a Roth is that you pay taxes on the money now, but all the growth is tax-free forever. If you invest $7,000 at age 25 and it grows to $100,000 by age 65, you pay zero taxes on that $93,000 of gains. Zero. That's incredibly powerful. Inside your Roth IRA, same strategy. Low-cost index funds. VU, VEI, or even a target date fund if you want something completely hands-off. Target date funds automatically adjust from aggressive to conservative as you get closer to retirement. Set it and forget it. Let me address something I know you're wondering about. What about cryptocurrency? What about Bitcoin and Ethereum? Look, I'm not anti-crypto. But if you're starting from zero, crypto should not be your primary investment strategy. Here's why. Crypto is incredibly volatile. Bitcoin has had multiple drops of 50 to 70%. If your entire portfolio is in crypto and it drops 60% right when you need the money, you're wiped out. However, if you want exposure to crypto, here's a reasonable approach. After you've built your index fund base, after you've maxed your employer match, after you've got your emergency fund, Then you can allocate 5 to 10% of your portfolio to crypto, not 50%, not 100%, 5 to 10% as a speculative position. Now let's talk timelines, because this is where expectations get completely warped by social media. You're not going to turn $100 into $1 million in a year. You're not going to retire in 5 years starting from zero unless you're earning and investing massive amounts. Building real wealth takes time. But here's what's actually possible. If you invest $300 a month into an S&P 500 index fund averaging 10% returns, in 10 years you'll have about $61,000. In 20 years, you'll have about $227,000. In 30 years, you'll have over $670,000. That's from just $300 a month. If you can increase that to $500 a month, in 30 years, you're looking at over $1.1 million. This is the power of compound interest and consistent investing. It's not sexy. It's not going to get you a Lambo next year. But it works. It's math, and math doesn't care about hype or trends. Here's something else critical. As your income grows over the years, increase your investment amount. This is called lifestyle inflation resistance. Most people get a raise and immediately upgrade their lifestyle. Bigger apartment, nicer car, more expensive habits. Instead, when you get a raise, put at least half of that increase toward investments. If you get a $3,000 raise, that's $250 extra per month. Put $125 toward investments. Your lifestyle still improves, but your future self also benefits. Let me give you a reality check on some common investing traps in 2026. First, meme stocks and whatever's trending on Reddit or Twitter. Yes, some people made money on these. But for every person who made money, 10 people lost their shirts. It's gambling, not investing. Second, day trading. Unless you're willing to treat it like a full-time job with years of education and accept that you'll probably lose money for the first few years, don't day trade. The statistics are brutal. About 95% of day traders lose money. Third, investing in things you don't understand. If someone's pitching you on an investment and you can't explain it to a 12-year-old, don't invest in it. Complexity is often where scams hide. One more thing about starting from zero. Your biggest asset isn't money, it's time. If you're in your 20s or 30s watching this, you have something that wealthy 50-year-olds would pay millions for. You have decades for compound interest to work. A 25-year-old investing $300 a month until 65 will have more money than a 45-year-old investing $1,000 a month until 65, assuming the same returns. Time is your superpower. Use it. So here's your action plan walking away from this video. Step 1. Create a $50 to $100 monthly surplus in your budget. Cut expenses, increase income, or both. Step 2. Build a $500 to $1,000 emergency fund in a high-yield savings account. Step 3. Open a brokerage account with fractional shares and zero commissions. Step 4. If you have access to a 401k match, contribute enough to get the full match. Step 5. Open a Roth IRA and set up automatic monthly investments into a low-cost index fund like VU or VTA. Step 6. Increase your contributions every time you get a raise or extra income. Step 7. Don't look at your account every day. Check it quarterly, rebalance once a year if needed, and stay the course. The reality of starting from zero in 2026 is this. It's harder than it's ever been to get started because costs are high and wages haven't kept pace. But it's also easier than ever to access the markets and build wealth systematically. You won't get rich overnight. You won't retire in 5 years. But if you start now, stay consistent, and give yourself 10, 20, 30 years, you absolutely can build significant wealth. The people who win are the ones who start, stay disciplined, and don't quit when things get tough. So here's my challenge to you. In the next 7 days, open a brokerage account. Fund it with whatever you can, even if it's just $10. Buy your first fraction of an index fund. Then come back to this video and drop a comment telling me you did it. I'll personally respond to every single person who takes action. And if you found this valuable, share it with one person who needs to hear this message. Subscribe to the channel because I'm dropping real financial content every week that actually helps you build wealth, not just get views. Thanks for watching, and I'll see you in the next one. Start investing. Start today.